people find trading stressful, but not me. Hi, I'm Shafiq. I'm a vlogger and trader, and today I'm sharing my best kept trading secret with you. I trade in local and global markets while on the move or even when I'm sleeping. I was one of those who were clueless about trading, but today it's all at my fingertips, 24/7, and I mean literally. Here, I trade in equities and futures at ease, and most importantly, at real-time prices. Everything you see here is live. And there's also live alert allow me to take action when the price is right for me on the Bursa listed stocks. When it comes to a trading platform, you really want one that is convenient and what works best for you, preferably one that offers better trading opportunities. When you see a good trading potential but you lack funds to trade, no problem. You have access to additional financing. The secret to being a good trader is not a secret at all. Once you have found the right trading platform, equip yourself to make informed decisions. Only the right trading partner will make sure of this. I truly appreciate the daily current updates by trading research analysts on the RHB Morning Cuppa at 8. It keeps me informed and up to date. With RHB Investment Bank, it doesn't matter what trading experience or strategy you have, your individual needs will be met. They are committed to you. And because of that, they are available for you anytime, anywhere, even when Malaysia is asleep and trading is active on the other side of the world. This multiple award-winning service is the right fit for any trader. It's even more rewarding when you can collect loyalty points for great rewards every time you trade. Nothing is more worthwhile than this. What are you waiting for? Download the app and start trading.
Good afternoon to you. My name is Alan. I'm from Group Retail, Equities and Futures. I'll be your MC for today. Thank you for joining us for this special edition, Monday special edition of Market Strategy. Today we have Mr. Tan Jee Toon, the Chief Investment Officer, Asia Pacific Equities from RHB Asset Management with us, Singapore. The title for today's webinar is Bull in a China Shop, a tale of reopening and recovery. A very enticing title indeed. Yeah, I would really like to find out what's going to happen if the bull is inside the China shop. So I also have with me Wafi from RHB Sekuritas, Indonesia, and also Tanapat from RHB Securities, Thailand, to join me as co-host today. So thank you for joining me, gentlemen. So before we go to the main event, allow me to share a few announcements. We are extending and streaming this live webinar live to our countries' counterparts, namely Thailand, Indonesia, Vietnam, and also Cambodia. A big welcome to all of you from there, right? And as usual, this webinar will be live streamed to RHB Morning Cuppa at 8. Right, and it will also be made available on this Facebook group, open group, RHB Morning Cuppa. Subsequently, it will be recorded and placed at RHB Morning Cuppa. So we will take some Q&As after Jee Toon's session. So before we pass to our esteemed speaker, please allow me to share some specials exclusively for you today. So in conjunction with the launching of the small cap book, we are having a triple bonanza campaign. You can triple your smart points, right? With every online trade of top Malaysian small cap companies featured in our RHB Small Cap Top 20 Jewels 2023 edition. So this campaign period has started since 16 May 2023, and it will run until 31st of August 2023. Okay, for this year's Asia Money Retail Brokers Poll, we have our head of RHB Retail Research, Mr. Joseph Chai, in the running for the award. So please scan the QR code to vote for RHB as the top broker, and also Mr. Joseph Chai as your favorite analyst. Okay, moving on. Enjoy expanded zero brokerage from RHB. Open an account now with RHB Investment Bank through Apply Now mobile app to get CDS fee waiver and enjoy zero brokerage for all online equities and local and foreign buy contracts up to 1,000 ringgit for 60 calendar days. So take advantage of this and enjoy this promotion. So next up is our latest campaign from RHB Investment Bank. It's called Electrify Your Trades Campaign 2023. This has been running since February 1st and it will go on until end of this year, 31st of December 2023. You will get a chance to win 236 amazing prizes worth up to 250,000 ringgit, including a brand new Mini Cooper SE electric vehicle and 235 vouchers. So the more you trade, the higher your chance to win more prizes. Okay, perfect brew to start the day. Morning Kappa at 8, our exclusive Morning Kappa at 8 Facebook group is now open for the general public as part of RHB initiative to increase public literacy on making informed investment decisions. So please scan the QR code to get your access if you haven't already done so. Next is our share margin financing campaign. When you open a share margin financing classic or exclusive account from February until 31st of July, so you've got until end of this month, you will get a special rate of 4.75% per annum, facility fee waiver, the facility limit that you apply can go up to 5 million ringgit with terms and conditions applied. And the next promotion that we have is for our Islamic share margin financing. In short, SMFI offers a special rate of 4.05%. We will also be giving waiver of CDS transfer fees up to 20 counters and stamp duty cashback. This campaign will also run until 31st of July this year. Okay, let's move on to the main event. So without further ado, please help me to welcome Mr. Tan Jee Toon. Jee Toon, over to, sorry, before Mr. Jee Toon, we have to pass to Indonesia and Thailand for their goodies and promotion. Over to you, Indonesia.
Okay, thank you, Alan. Please allow me to present in Bahasa. Selamat siang, Bapak Ibu Smart People. Saya Muhammad Wafi. Jadi sedikit promosi sebelum kita mulai dengan Tan Jee Toon dari Indonesia. Ada beberapa promosi yang bisa Bapak Ibu amati. Yang pertama adalah Smart Free. Jadi untuk Smart Free ini Bapak Ibu bisa menikmati biaya jual beli saham yang sangat terjangkau sehingga serendah 0,08%. Dan yang kedua adalah Smart Rate, maksimalkan potensi transaksi dengan bunga margin ekonomi serendah 0,025% per hari. Okay, next number 3 kita punya di nomor 3 ada Smart Point. Smart Point adalah point reward yang dihasilkan dari nilai transaksi investor dan bisa ditukarkan dengan e-wallet. Dan yang keempat adalah Smart Analyzer, di mana analisa saham menjadi mudah lewat fitur arrow untuk mendukung keputusan investasi. Oke, nah next. Dan kita juga memiliki RHB Trade Smart Syariah untuk Bapak Ibu yang ingin melakukan investasi secara syariah dan amanah. Salah satu bulannya adalah seamless digital account opening yang bisa dilakukan melalui aplikasi sama-sama real time, quick, easy, dan smart. Oke, next. Oke, untuk promosi tersebut berlaku sampai dengan Desember 2023. Dan juga kita punya one more video promotion dari structure warrant kita. Please.
for you now. You got 2 minutes of my time, and I don't really break too easily, but I'm worth it, 'cause I'll slip into your dreams tonight. Oh, so give me your all. I'll take it to Mars. Oh, I'll stick like glue inside your mind. Just watch me break in. You'll swear you're falling into me, touch me. I swear you would do anything that I want, so keep us awake till the dawn. Baby, feel free. I wanna make you sweat.
Oke, mungkin itu beberapa promosi dari Indonesia. Pass it on to back to Alan. You're still muted, Alan.
Thank you, Indonesia. Okay, let's move on to Thailand. Over to you.
Thank you, Alan สวัสดีนักลงทุนทุกท่านนะครับสำหรับโปรโมชั่นของประเทศไทยนะครับเทรดได้ให้เลย Diamond Plus ค่าธรรมเนียมทุกการซื้อขาย40 บาทรับ3 point ทุกประเภทบัญชี point สะสมประจำปี2566เริ่มตั้งแต่วันที่1 มีนา2566สิ้นสุดวันที่31 ตุลา2566ค่าธรรมเนียมทุกการซื้อขายรับ3 point ลูกค้าสามารถแลกซื้อกองทุนรวมกองทุนลดหย่อนภาษีหรือสินค้าสมนาคุณตามที่บริษัทกำหนดครับส่วนการตรวจสอบ point สะสมpoint คงเหลือตรวจสอบได้ทุกวันที่2ของเดือนถัดไปได้ด้วยตัวเองผ่านเว็บไซต์ผ่านเจ้าหน้าที่การตลาดผู้ดูแลบัญชีของท่านหรืออีเมลมาที่th.support@rhbgroup.com next one please ส่วนโปรโมชั่นที่2 DCA Smart Fund ลงทุนต่อเนื่องผ่านกองทุนรวมกับ RHB ลงทุนต่อเนื่อง6เดือนและมูลค่าสะสม 12,000 บาทขึ้นไปรับหน่วยกองทุน K-Cash เพิ่ม 0.2% ของเงินลงทุนอัตโนมัติหรือเลือกรับเป็นบัตรกำนันอิเล็กทรอนิกส์ Tesco Lotus ตั้งแต่วันที่15 มีนาถึงวันที่30 ธันวาคมสำหรับประเทศไทยมีโปรโมชั่นเพียงเท่านี้ครับ Thank you Alan next to you
Thank you. Okay, moving on to the main event now. So Jee Toon, the floor is yours.
Thank you very much, everyone. First things first, I'd like to thank everybody for taking time to listen to our lunch session today. So, like what Alan has mentioned earlier, so the title for today's presentation is Bull in China Shop. So I think, like what Alan has mentioned, I do think that it's a very, very appropriate title to describe maybe what is happening in the market right now. So if you look at the actual definition of what does a bull in a China shop means, it means that, essentially what it means is that you have to be very, very careful, right? It's like a bull that happens to find itself in a shop full of delicate China pieces. So you have to be very, very careful at this point in time. But nevertheless, the other meaning that I think what it means is also, I am a bull, right? I am a bull. I do think that China will do well in the second half of the year, and in fact going forward, because it's a tale of reopening and recovery. So that's why I for the second half of this year, this is the title of my strategy, which is a bull in China shop, because I think it does have a double meaning, and I think it does reflect very, very well what is happening to the market as we speak. Okay, so in today's presentation, we're going to break it up into a few parts. The first part is I'm going to very, very quickly go through the global macro indicators, and I'm sure a few of you would have, or quite a few of you would have heard what Dr. Shah has talked about previously. So for me, I would give my own interpretation and my spiel of how I see the global macro indicators and how does it apply more importantly to Asia and our parts of the world, which I think most of our focus would be on for today's session. Okay. Next, I will also very specifically touch on China in particular, going through what I think are the key drivers or the key themes, which I think are important for China for the rest of the year. And all these all linked back to reopening, recovery, and what is happening in China with the removal of zero COVID policy. Okay. So these are this is in essence what we're going to talk about for today's lunch session. And also, I want to leave ample time for us to answer any questions that you may have, because I think, knowing from previous experience, I think this group is obviously made out of very, very experienced investors who are well versed in the market, and I do welcome any questions that you may have. I think that will make for a more interesting session for everybody. Okay, so very, very quickly, let's jump right into what I think are the more important global macro indicators. So on this chart here, very simple chart of just inflation data. Okay, this is the US headline inflation data and the US core CPI data. So no matter how you look at it, you can see quite clearly that inflation is tapering off. And if I remember correctly, during my last session here, when I talked to everybody, I did mention that my view is that inflation will start to taper off. Right? We already saw that happening in Asia, saw that happening in China, and I think it's just a matter of time before US follow down the same path. So you can see very, very clearly over the course of the last few months, inflation has been falling and falling off quite dramatically as well. So the headline inflation roughly is about 4%. Still, I would say, above, obviously, still above what the inflation was pre-COVID, which is around about 2.5. But I will also argue that in this new world that we are living in, whereby there is decoupling between US and China, when there's also concern about ESG, where there's talks about geopolitics, talk about friendshoring, offshoring, reshoring, and also we are well aware that inflation is obviously higher now compared to previously, and that is probably a bit more systematic than what people may like. My view is that I think inflation in the post-COVID world will be higher than what we saw in the pre-COVID world. So my view is that the previous years of 2.5%, I think those are years and days that have long gone, right? We probably will not go back to those days in the foreseeable future, right? So my point is the inflation going forward should be higher, a tad higher than what we saw pre-COVID. But nevertheless, I just want to point out on this chart here, like what this chart here has clearly shown, inflation in US is falling off dramatically, but still quite some way above what I think would be a more sustainable trend going forward. But however, my view is within the next 6 months or so, it will fall to their levels, which I think will roughly be about the 2 to 3 range. Okay? So the other thing I also want to highlight is that I think for some parts of the investment community, people look at this data and they look at it and say, hey, they feel that inflation is not going down fast enough, right? So I just want to bring back to my earlier point, right? Inflation is coming down, but it will not go back to what it was pre-COVID. Okay, so this is an important distinction that I want to make. And also on this chart here, very simplistically, it's just a US labor market chart. So you can see that non-farm payroll has been quite high, and that's also reflected in the average hourly earnings. So for those of us who look at the data, this is probably the set of data, right, that goes against the inflation coming off in a big way. Okay, so this is why I think wage in general, in US in particular, has been rather sticky, because non-farm payroll, in essence, has been quite high, and average hourly wage is still on the uptrend. Okay, however, I just want to point out to everybody, but if you look at the leading indicators, right, the now indicators, which is the metrics that you see now, obviously things like wages, non-farm payroll is still high. But if you look at leading indicators, and obviously some of the strongest leading indicators that we have is obviously the ISM PMI numbers. So the US ISM manufacturing data, as you can see from this chart here, has been on the downtrend for the longest time. And in fact, it has been in contractionary territory, means it's shrinking, which is how you read it is it is below 50, which is this white line here, which means roughly from October of last year until now, US manufacturing has been shrinking. Okay, and even if you look at the service data, right, the service PMI, and service PMI is one of the main reasons why wages in the US have been rather sticky. Okay, but if you look at the leading indicator of the PMI numbers, you can see it is evidently on a downtrend. And one could say it's just barely at the point where it's going to be in contraction territory. right? So having said that, like what I mentioned earlier, this is leading indicator, which means that this is probably predictive of what might happen. Okay, whereas the non-farm payroll and the average hourly earnings data are reflective of what is happening now. So if you look at what is going to happen in the future, my sense, our view is that I think all this point to a slowdown at some point in time in the foreseeable future. All right, cool. So this is my view. I think this could be a bit different from some of the consensus view out there who thinks that US is in for a soft landing or US there's no recession at all in the US. From my perspective, I don't think so, because I think for those of investors who look at that and say that US is not in a recession, I think I think they are looking more at the now data, the data that's happening now. But if you look at data that is more leading and that happens to be a lot more predictive, then I think it paints an entirely different picture. Okay, and also on this chart here, very quickly, I've shown this chart numerous times in my previous presentation. I just want to highlight to everybody is that right now Fed fund rate is 5.25. Obviously, they have paused in the recent opportunity for FOMC to adjust the Fed fund rate. So some people are calling that skip, meaning that rather than pause, meaning that you will pause and you will not move, people are saying that it will skip, meaning for the next few sessions, there might be a possibility of a rate hike. So what the market is pricing now, the market is saying probably one rate hike, maybe 1.5. So so the second one is not so certain, but possibly one rate hike before the end of the year. And also more importantly, by November, that should be peaking, and then we should see some rate cuts happening from late this year and early next year onwards. So this is what they are saying. So in fact, the market is pricing in 3 to 4 rate cut in 2024. Right, so like I said, this is what the market is pricing in right now. So this is not my data, but this is rather what the market is pricing in right now, which is, just to summarize, 1 or possibly 1.5 rate hike by the end of this year, right? Followed by a rate cut, possibly starting from the end of the year all the way to next year. Okay, so this is what the market is pricing in right now, which I want to highlight. It's a very, very different scenario than what it was in 2022. In 2022, it was all about rate hike. Everybody was talking about how fast or how aggressive the Fed is going to be. But this year, the whole story has changed. And I think next year, the story will change even further. And I think this is very important for us as investors, right, to recognize that as a backdrop. Okay? And also, that also has relations to our view on the US dollar. Okay? And for those of you who have followed me or who have listened to me previously in the last few sessions, you have known that I called for a peak in the US dollar late last year. And in fact, even throughout this year, so far so good, right? US dollar, like what we mentioned earlier, has peaked in late 2022 and in fact has come down considerably. And in fact, throughout the last few months, it has more or less hovered at roughly about the same levels, right? So our view, like I mentioned earlier, and that has been our view for the last few months, US dollar has probably seen its best days. 2022 was at a 20-year high. I don't think we're going to be at that levels. And that was our view in December of last year. And we continue to hold that. And that will have obviously implications for us in our parts of the world, right? A weaker US dollar is usually beneficial to risk assets. It's also usually beneficial to Asian equity markets, China equity markets, and emerging equity markets in general. Okay, so this is some of our key views in terms of the global macro indicators. So for this next part of the session, I want to talk a bit about the China macro indicators because I want to link back to the title, A Tale of Reopening and Recovery. So on this chart here, I'm also looking at the China PMI data. Okay, so on this chart here, I have two sets of data. One is of the China official PMI numbers, which is, you can see are the solid lines, right? The solid blue line is the China non-manufacturing or the service PMI numbers. The white solid line is China manufacturing PMI numbers. Okay, I also tend to look at the Caixin PMI data. So the dotted ones, right? The dotted teal or the green line is the Caixin version of the non-manufacturing or service PMI. the beige version is Caixin version of the manufacturing PMI. So there is a difference between the two. Okay, so obviously one is collected by government, the other one is collected by private entities. Okay, and in terms of composition of PMI, it's also very different. The official China numbers usually is made up of the larger companies, the larger state-owned enterprises, whereas the Caixin manufacturing or the service PMI has a larger proportion of SMEs, the mom and pops. So from my perspective, I tend to look at both sets of data to give me an understanding of what is happening to China. Okay, so, and I've also highlighted here very, very clearly this yellow vertical line here, which actually denotes December of last year. So you can see quite clearly that 2023, if you look at the data, is a year of recovery, is a year of reopening. You can see the many service PMI numbers, be it from the official China non-manufacturing PMI number or the Caixin service PMI number, it has bounced up very, very nicely, and it has held up very nicely over the course of the last few months. So anything, like I said, anything above 50 would denote expansion. So the service part has done very, very well. So as you can imagine, right, after being locked down in your home for 3 years, as what the Chinese people endured over the course of the last few years. So when China opened up, they started to consume. They started to enjoy services, right? So that's why the non-manufacturing PMI or the service PMI numbers are indeed much higher than before. Very nice V-shaped recovery. Okay, then the other one, which is a bit more trickier, is the manufacturing PMI numbers. So we can see that it's hovering. There is a nice rebound as well post-December after a very, very nice uptick in the first few months. Then it started to taper down. Okay, and what is the reason behind that? The reason can actually be attributed to what is happening in the developed markets. Because we understand that the developed market, especially in the UK, in Europe, they are obviously facing weak economic conditions, and arguably in the US as well. If you look at what is happening in the PMI numbers of the US, and also if you look at the results of the American companies, a lot of them have come out and reflected that they are seeing weaker demand as well. So that is why China, right, no matter what, is still a factory of the world, right? So if the world is not consuming, especially the developed parts of the world are not consuming, then that's where I think on the manufacturing side, China will face some headwinds, and therefore we are seeing this kind of scenario. Okay, but nevertheless, I just want to point out, even for the manufacturing part, we are seeing clear signs of recovery post the end of zero COVID policy. Okay, and moving on, I just want to highlight other data points as well. If you look at China retail sales, for example, you can see quite clearly as well as what this chart here, which is the PMI number. Retail sales are real numbers, are numbers that are being reported by the companies. You can see retail sales is going up very nicely, right? A V-shaped recovery from what we saw in December, bounced up very nicely. Same thing for industrial output as well. Output is growing. It is in the positive territory over the course of the last few months. So this is what we are seeing in terms of real data. So that's why if you link back to my title, I do think that China is recovering due to its reopening, due to the end of zero COVID policy. Okay? Next, I also want to highlight to everybody the difference in the economic situation in China versus the US. So if you look at China, right, you look at China inflation situation, okay, which is this red line here, China CPI numbers. You can see China has no inflation problem whatsoever, right? No inflation problem whatsoever. It is in fact back down to pre-COVID levels, right? So obviously, in terms of US CPI, you can see it's coming down, but if you compare that to the levels that we saw in China, I think China is still much better off. There's no inflation scare in China. So in fact, if you could look at it in terms of China PPI, which is the price that is faced by manufacturers in China, is in fact in a deflationary situation already, because like I mentioned earlier, right? Because the demand from the rest of the world has been pretty weak. Okay, so this big difference in the inflation outlook of US versus China is in fact what makes China so interesting. Because of the lack of inflation in China, I think Chinese central government, the central banks, have a lot more tools at their disposal that they can enact to buffer and to help China, to stimulate China, even if China is in a slowdown. But if you look at the Americans, it's very hard because they need to conquer or they need to subdue the inflation first before they can talk about stimulating the economy. But China is a different kettle of fish altogether. There's no inflation scare in China. So that's why China monetary policy, fiscal policy, right, and the overall stance of the central government is very, very different compared to the rest of the world. Okay? Next, and this is easily reflected in the monetary support that we are seeing in China, right? So you can see quite clearly that the prime rate has gone down dramatically. And even if for 2023, the rates has been cut. Policy rates in China, no matter how you look at it, has been cut. You can look at the 1-year rate, the 7-day repo, you can look at the 5-year prime lending rate. It's all moving in the right direction. All the rates are getting cut. So it shows that the Chinese government, the Chinese central banks are providing monetary support and stimulus to the Chinese economy. So once again, very, very different scenario or very, very different picture compared to what we see in the rest of the world. Okay? And also, last but not least, we want to look at valuations because I'm sure all the investors here are very, very experienced and you understand how important valuation is. So right now at these levels, right, we are roughly right smack at where we are during the COVID lows. So this at this point in the cycle, this is when COVID first hit, right? That was when COVID first hit. So we can see quite clearly that right now where we are at COVID levels low. So in terms of valuations, right, I do think that there's a lot of pessimism which is being priced into the market right now, and that's too much, right? So I do think that for those of you who are value investors or who wants to look at valuation as a key metric for your investments, and I do think that China PER ratio or the price earning ratio, it looks very, very attractive. Okay, and last but not least, I just want to touch on very, very quickly on the difference in GDP growth. For those of you who have listened to me before, I like to show this chart just to give everybody an understanding of what kind of GDP growth that we are seeing all over the world, right? So those parts in green are obviously in China, which is doing very well. So my view, China GDP growth this year, government says roughly about 5. I do think that they'll probably hit that. So 5 is something that I'm looking at. So this 5.2 is actually given by the IMF, right? So I tend to more or less agree with the direction that they are going. So roughly about 5. So if you look at the developed markets, right, US, Europe, UK, even for IMF, you can see quite clearly it is indeed slowing down quite dramatically from the levels that we saw last year, right? So I just want to make that distinction here. I guess not just for China, but also for Asia in general, right? If you look at Malaysia, look at the ASEAN countries, look at India, I think all these economies are still charging along nicely. Why? Simple reason is because we are only starting to reopen, right? We have been locked down for so many years, right? The Americans, the Europeans, the Brit has reopened much faster than us. So last year was a good year for them because they reopened first. So this year they're facing slowdown because of recession. But for us, even though interest rates is indeed higher than normal, but fortunately for us, in our parts of the world, we are starting to reopen. Our economy are starting to recover, right? Or in the early stages of recovery. So I think in terms of GDP growth, fortunately, we are still quite much higher than the levels that we see for the developed markets. Okay, so this is the comparison of GDP growth in Asia versus the developed market, which is the last 3 lines here. And also very quickly, I want to touch on some of the key investment themes that I think are important to look at for China for the second half of this year. Okay, so on this chart here, I wanted to highlight to everybody where we are in terms of the potential scope of recovery of the Chinese international passengers, right? In our parts of the world, be it in Singapore, in Malaysia, particularly in Penang, and all these KL, and all these places where there's a lot of Chinese tourists, and also to a certain extent Thailand as well. We are all waiting for the influx of Chinese visitors to resume their tourism in our parts of the world. Okay, so this is a common trend that we see across all the different countries in ASEAN. And I just want to highlight to everybody what is the potential scope. So as of the data that we have by late April, right? So this light blue line are potentially what we can look forward to if China were to revert to their pre-COVID levels. Where we are now is just a fraction of where we can be. So the potential scope of recovery is massive, right? And also the dark blue line here is essentially the visitors to Hong Kong and to Macau. So once again, similar picture. I think we are still a long way off in terms of full recovery to pre-COVID levels. And that obviously offers investors like ourselves ample opportunities for us to find stocks that can benefit from this scope of recovery. Okay? And on this chart here, another way to look at this is we look at the Macau gross gaming revenue or GGR. Right? You can see quite clearly, yes, it is indeed coming up nicely, right? But nevertheless, like what I mentioned earlier, it's still quite far off from what it was pre-COVID. So this is some of the key trends that we are anticipating, and therefore we will try to invest in order to benefit from these key trends. Okay, and I also very quickly want to talk a bit about China property sales. So I'm sure all of you here are well aware of the troubles and the trials and tribulations that we saw in the Chinese property sector in 2022, right? So I just want to update everybody what is happening in China property market since then, right? So you can see quite clearly here on this chart here, this is the new home sales, right? And the dotted line that you can see here is the data for 2023. So we can see it is recovering. It is recovering compared to the levels that we saw in 2022, and to a certain extent, the level that we saw in 2021 as well. So the point I want to highlight to everybody is we are recovering. It is a steady recovery. Is it going to be a sharp V-shaped recovery? The answer is no, right? So in fact, the entire sector is arguably, if you look at some of the newspaper reports, is still in a weak situation. I can explain to everybody why the overall big picture data is still weak. So on this chart here, I want to point out to everybody, or I want to highlight to everybody the contracted sales growth of the companies that we monitor. So roughly there's about 20 companies here, right? So we will look at the contracted sales growth. So these are the actual sales that all these companies had from January to April of this year. And I compare that to the January, April of last year, right? So if you look at the data, if you depend on who you ask, right? Which company you ask. If you ask them, are you doing well in 2023? And the answer is, it depends on who you ask. Because if you look at USU, Evergrande, CRLand, Colley, Greentown, Jingmao, they will tell you they're having a good year. Because if you look at their year-on-year comparison, some of them are up as high as doubling of their sales that they saw in 2022, right? And all these companies, all the major companies here, are seeing pretty nice year-on-year increase in property sales, right? Anywhere between 40% all the way up to doubling, like what I mentioned earlier. So that might surprise some of you who are seeing data that shows that Chinese property sales have been weak. Okay, I'm not trying to say that those data is not correct. Those data are correct, but for us as investors, I need to dive underneath the big headline numbers and try to figure out what is happening on the ground. So if you look at other companies here, right? For example, R&F, Logan, Sunex, Shima. If you ask them, are they having a good year? 2023, they will tell you they're having a horrible year. Last year was a weak year. This year is even weaker. They are in fact contracting. Some of them are down by half, right? And if you could analyze the data further, which I've highlighted here, right? So for those companies that are SOE developers, meaning they have government parentage, right? Be it central government or provincial government parentage, and those are highlighted in blue, you will notice that it correlates very well to how well they are doing, right? So if you are quasi, meaning you are partially owned by the SOE or the government, then you tend to do quite well as well, right? Last but not least, you see two orange bars here. One is Evergrande, one is Longfor. Evergrande, as you know, is the second largest developer in China. Longfor is also a very high quality developer. So what does the data actually tells us? The data actually tells us that the Chinese people are very discerning. Are they buying property? The answer is they are. But they are not buying across the board. They look at the developer. If you are an SOE developer linked to the government, chances are you will not fail. I will buy from you because prices are cheap. If you're quasi-SOP and you quasi-SOE, meaning you're half-owned by a developer and you're good quality, I'll buy from you too. And if you are a private developer, I'll only buy from you if you are the biggest of the big and you are very, very strong, like what is in the case of Evergrande and Longform. But for the rest of the market, right, I think the Chinese investors or the Chinese property investors are very discerning. They say that I'd rather not buy from you, right? So I just want to highlight to everybody, you will see headline data for Chinese property sales to be weak, but it's important to understand the numbers underneath the headline numbers, as I've shown here. Okay? And also, I just want to highlight to everybody that the Chinese government is obviously well aware that overall Chinese property sector is still in a weak situation. And that's why they're pushing through a lot of property support package. So once again, it ties back to the title of recovery and reopening. Right? So I do think that we are in early stages, but the Chinese property market is slowly but surely recovering, right? Albeit in a slow and steady manner. Okay? And moving on, I also want to highlight to everybody in terms of other indicators of how I look at the recovery and the reopening place. So on this chart here, I've highlighted China total passenger vehicle sales. So you can see quite clearly that it is coming up, but it's coming up not in a sharp V-shaped manner, right? So once again, I've seen some people who look at this and say that, oh, Chinese passenger sales are not good, right? It's rebounding, but it's not good, and therefore Chinese consumer sentiment is weak. So once again, just want to highlight to everybody, we need to look at what is underneath the data. What does, if you have better data, if you have knowledge of the Chinese economy, what actually is happening in China at this point in time? And you can see this in this chart here. So we can, on this chart here, is just China electric vehicle sales. So if you look at it here, you can see very clearly that in September, October, all the way until December of last year, there was a huge surge to buy electric vehicles. Why is it so? The reason is because of tax credits. Tax credits were supposed to expire at the end of last year. So that's why people who wanted to buy cars, wanted to buy electric vehicles, they all rushed to buy electric vehicles before the tax credit expired at the end of 2022. And therefore, you can see this massive, massive surge right here. So that provided a high base, because if you want to buy a vehicle, there's a big difference if you buy in 2022 and 2022 or if you buy early 2023. So we are all consumers, we know what you're going to do. We're just going to pull forward our demand and buy our vehicle late last year and not buy the vehicle in early 2023. So this is what is happening, and therefore that provided a high base, and therefore that distorted some of the numbers here, right? So you can't just look at the passenger data and say that, oh, Chinese economy is weak, because there are things that is happening on the ground that is distorting the numbers that is being published. Okay? And I just want to highlight that Chinese government is obviously well aware of that. So what they are doing is extending this electric vehicle tax incentive all the way until 2027, right? And all this has just happened within the course of the last few weeks. So once again, it ties back down to our thesis of recovery and reopening, right? China government is on a path to extend and to promote the electric vehicle market in China. Okay, and the other thing I just want to highlight to everybody is also a key theme that we are playing this year, which is the SOE reform themes. SOE is state-owned enterprise, right? So this year we have seen substantial changes in the KPI or the key performance indicators of this state-owned enterprise, right? In terms of measurements of return on equities, profitability, dividend, operating cash flow. And our view is that will probably cause a substantial change into how these SOE are being run for the foreseeable future, right? So this is a new theme that we are playing over the course of the last few months, which I think is very interesting, and that's why I highlight to everybody here. Last but not least, I think everybody is well aware of what's happening on the ChatGPT AI front. China is definitely, jumping on the bandwagon. They may not be champions, especially on the hardware part, which obviously NVIDIA is probably the only company out there that is getting most of the benefit. But Chinese companies are benefiting from the perspective that they are utilizing all this AI onto their platforms. So we have seen that happening on the platforms of Alibaba, Tencent, Meituan, right? So AI is becoming part and parcel of their product offering, right? So these are some of the trends that we are playing over the course of the last few months. So with that, I've come to the end of my prepared remarks. Maybe I will hand it over to Alan and the rest of the moderators, and maybe we can take some questions.
Okay, thank you, Jee Toon, for that insight into the China shop. So at least we have a bit of a view of how the bull is doing. Okay, so it's time for some question. Okay, let me start off with this question. China or Hong Kong, the banks are giving quite decent dividends, maybe about 4-5% on average. But is there a concern on their balance sheet? And also, last year, some say that the rural or provincial banks may face liquidity issues. So what's your view on China banking stocks?
Okay. The short answer is I'm actually very positive about them. And I agree with what Alan is saying. I think the dividend yield on all these banks is in fact quite high. So I think the Chinese bank is probably in the range of 6 to 7% yield, depending on the bank that you're looking at. And I don't think there are any real issues of them going under. Because if you think of it at the end of the day, right, the biggest customers of the Chinese banks are the SOEs. And who are the biggest owners of the Chinese banks? It's the Chinese government. So essentially, this is a left pocket, right pocket issue. So the Chinese government are well aware of the problems. They are managing the situation to make sure that obviously the banks will have to do some form of national service. But will they go under? The answer is no. Right? So I do think that in terms of where the banks is trading at, I do think that it's quite attractive, especially if you believe that the Chinese economy is on the mend with the end of the zero COVID policy. And Ellen, you're quite right. That the dividend does provide a very, very strong support, right, in terms of valuation. And in terms of your question, in terms of the rural banks, the answer is it depends. It depends on what rural bank that you're talking about. So for us, we tend to look at rural banks that are in the more developed regions of China. Those guys are okay, right? So if you are in the eastern seaboard, or you are in the cities and provinces that are well developed, then you are fine. However, if you these are some of the smaller banks that are exposed to the smaller provincial region, then you might be in trouble, right? So for us, for our portfolios, we don't touch those. So in fact, I have not touched the rural banks for the last 3 years. In fact, pre-COVID until now. The reason is precisely that, right? You don't know, you see. So I'd rather stick to the large banks. And besides, like what you mentioned earlier, dividend support is there. And I do think that they will be well supported by the government. In essence, it goes back to the same point. Those guys are too big to fail, right? So I do think that the Chinese banking sector is a lot more interesting. And also just related to the point that I raised earlier about the SOE reforms, right? So the Chinese banks, I guess since I've been investing in this market for the last 20 plus years, right, have been doing national service, right, so to a large extent. But with this SOE reforms, right, that makes things interesting because SOE reform has made it very clear that this SOE have to focus on ROEs, profitability, operating cash flow, and all of that. So I do think that that provides a good framework for them to push back against unnecessary national service duties. Right, so I do think that that provides another extra incentive, right, for us to relook at the SOE sector, right? Okay, Alan, over to you.
Okay, thank you, Jee Toon. Okay, let's move on to the next question. As we know, and also like what you have reiterated, China central banks has been cutting down the rates, right? They have been cutting down the rates, but however, the stock market reacted quite negatively. It's not as positive as we wanted it to be, right? So do you see this monetary stimulus that they are talking about, does it really works? And second part is that how long does it take to see it takes effect?
Okay, so I just want to highlight that the monetary policy is obviously, ultimately it's the responsibility of the central bank, right? So I don't think the central bank will look at the stock market and adjust their monetary policy because of what's happening to the equity markets, right? So that's one point to highlight. Okay, the way that they adjust their policies, it's what is happening onto the ground, right? And I just want to delink that because I think we are used to the fact, especially in the US, right? Because of the amount of money that they are printing, right? Every time they turn on the printing press, then the stock market goes, right? So there is a more of a direct impact there because of a variety of things, the way the US stock market is being structured, and also more importantly, how much money is being printed, right, relative to the size of the stock market, right? So if you know, there's QE1, QE2, QE3, QE infinite, all of them, right? Every QE has been doubling the size of the last QE, right? So that's why US is in a very bad shape in terms of their fiscal position, right? And also in terms of their indebtedness, right? So we have to delink that from what is happening to the US to that using that relationship and try to extrapolate that onto China. Okay? And also just want to highlight, right, the reason for China's headwinds over the course of the last few months are quite separate and different. Okay, one, I think the biggest one is also the US-China tension, right? So that one is independent of what the central bankers can do, or independent of what for us as investors can foresee. Because we know that there's going to be a structural theme, right? US-China tension is here to stay, and I mentioned that numerous times in my previous presentation, right? So that, nevertheless, right, when the news of those came out, or those negative news comes out, then there will be a negative impact on the share prices, albeit for the short term. So that is one. The other one is over the course of the last few months, there have been noises of a potential second wave of COVID in China, especially in March and April after the Chinese New Year, right? So obviously that happened, but nothing much, right? So there was numbers came out, but then it just went away without any incident. I think we can see that all over the world, right? Even in Singapore, we are seeing waves, but then life goes on, right? So this is what happened in China, but obviously there was a bit of reaction there, and also I do feel that it's also a function of how the Chinese equity market have performed immediately after the news of the zero COVID policy was abolished, right? So from November all the way until its peak, China actually rallied as high as 60%. So the peak was roughly in February of this year. And subsequent to that, the market has come back off roughly about 50%. Right? So if you look at the Fibonacci, you can analyze that, right? So there is a bit of retracement. But people look at it and say, oh, this year China is down. But the point is, you have to look at the context of the rally in the Chinese stock market. How much it had rallied. It had rallied 60%, and then obviously it has come up, and this retracement is obviously quite normal, right? In the overall scheme of things, right? So obviously people are focusing on that, and then look at it and say that, oh, China hasn't been doing well. But I would say it depends. Once again, it depends. You need to look at the relative time frame, right? And also, just to add to that mix, right, is also the performance of the S&P, right? S&P is obviously the massive outperformer, right, across all the different stock markets out there that has taken investors by surprise. But if you look at the outperformance in the S&P, I'm sure all of you are well aware of that. That if you take away anywhere between on a given day, anywhere between 8 to 10 stocks out of the S&P 500, right, S&P is in fact in a negative territory. So a very, 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 very small handful of stocks in the S&P, right, is responsible for the outperformance. And we all know what these names are because it's all related to the AI team, right? NVIDIA itself is a huge component. It has done so well, right? So that has pulled up all the AI names also. So I think this is also a function of why China has failed. But if you look at stock performance across all over the world, right, it has more or less been the same. So if you look at Taiwan as well, look at Korea as well, the only sector that's pulling up the whole market is the tech sector. Anything that is connected to the AI sector has done well. Then obviously at this juncture, people are starting to ask them, then at what point in time it's going to be too much, right? So we're looking at Nvidia PE, trading PE is roughly about 80 times, or PE is roughly about 50 times, right? So I think I'm not trying to say that I don't like Nvidia. We like Nvidia. We have Nvidia in the portfolio. But my point I want to highlight to everybody is I think we need to look at the relative valuation of all these things, and also at this juncture we are seeing a very, very narrow set of names that is pulling the entire stock market up. And from my experience, right, what history has taught us is when these kind of things happen, usually there will be some form of correction, right? So I just want to put everything in context to highlight this. Okay. Yeah.
Okay. Yeah. Thank you, Jee Toon. Okay. Let's move to Indonesia for some question from their side. Wafi, you got anything for Jee Toon?
Yes, I have one so far. Thank you, Jee Toon, for your presentations about the China bullish trend. The question is about regarding the commodity, because when we talk about China, of course, obviously we talk about the commodity. How do you see about the commodity prices, especially for coal sector, and if I may add, also from the nickel sector, because China is one of the largest consumers for nickel, right?
Okay, I think I'll take the easy one first, which is actually the nickel sector. So I think that we are very positive on the renewable energy sector. We're very positive on the electric vehicle sector. So and Indonesia being one of the largest producer of nickel, and I do think that Indonesia is very, very well positioned, especially with the processing initiatives that Jokowi has implemented over the course of the last few years. So I think it's all playing in the right team, right? I think Indonesia is doing all the right thing in terms of value-adding services to the nickel sector. And that's definitely going to be very, very, very beneficial to the Indonesian economy. And in fact, we do have quite a fair bit of exposure there to not just the Chinese fund, but also to our ASEAN funds, to our global funds, because we do think that that is something positive. And also, I think, and not just part of what President Jokowi is doing, it's also the fact is the sector, the trend is indeed very, very strong, right? Electric vehicle, renewable energy, I think this is here to stay, right? This is something that the whole world can agree upon, whether you are Chinese, you are Americans, you are Europeans, right? Or you are Asian, everybody can agree that I think green energy is the structural theme that we can play for the foreseeable future. So that's the short answer. So in terms of coal and other materials, I do think that there are a few crosswinds. So it's not so clear cut. The reason is because I think for the material sector, China is reopening, but China is not going to have that big bang that we saw previously. So that's never been our base case, right? So those people who even talk about China's having big stimulus, I don't think they understand China at all. We are never going to have a major stimulus because it's not necessary and it's just a waste of money, right? So the stimulus there is not going to be big. It's going to be very, very, very targeted. Okay, so the material sectors specifically will benefit in a very narrow part. Okay, and also more importantly, right, I think that globally the material stocks in general also trade, right, relative to their LME prices. And if you look at the material prices in general, those guys are facing headwinds from the overall weakening global economic scenario, right? We have Europe slowing down. One would argue that UK is already in a recession. Europe is probably tipping to recession in the near future, especially if they don't resolve the Russia-Ukraine issue, right? Last but not least, I think the point, like I mentioned earlier, I think for the US, I think roughly speaking, I think the market is split, right? Those people who look at the now data, what I call the now data, right? The current data will say that I think US is fine. US is fine, no issue, economy is strong, but I don't think so, right? I don't think so, because a lot, we all know, right? Something happened very, very slowly, then all of a sudden, all at once, right? I'm pretty sure if you look at the leading indicators, you can see US is slowing. If you look at the companies, the American companies that are reporting data, you can see that they're already slowing down. Plus the fact that you look at some of the stuff that nobody talks about is, for example, the real estate situation in San Francisco, real estate situation in big cities in the US, right? Interest rates are high, vacancy have gone up because of this remote working issue, plus the fact that in the case of San Francisco, their own self-inflicted problems, right? All these things, we're talking about billions and billions of dollars, and we are not even pricing any of that in yet. So I do think that if you look at that, right, for the US, like I say, it's 50-50 now. You know where I stand in terms of how I see the US market. But in general, right, people are quite defensive, in all this, and therefore that will have reflection on the material sector, right? So I do think that depending on the material sector that you're looking at, so we are tactically overweight some, but we are also underweight others in the material sector. Okay.
Okay. Thank you, Jee Toon. I also got one more question came directly to me. So, as a global fund manager, I think chief investment officer, I guess. How do you rank Indonesia as is it the most beneficial from the China pool, or compared to the rest of the Asian country?
Okay, so there are a few ways to look at it, right? So if you look at the direct impact of linkages to Chinese economy, I think Indonesia, like what you mentioned earlier, does have pretty strong linkage because of the materials and the commodity sector, similar to the Australians, right? But I do think that what Indonesia has going for it is also the fact that because of the US-China tension, you can see quite clearly that the China plus one policy is starting to gain momentum in ASEAN, right? So we see that happening more conclusively in this year. So I think for our parts of the world, I think Indonesia, Thailand are well positioned to take advantage of that, and to a certain extent Malaysia as well. So that's why industrial estate plays in Thailand, in Indonesia, to a certain extent have done well, right? Because we are seeing and hearing more and more, I guess not just Chinese, Taiwanese, Japanese companies who are trying to diversify away from just the onshore in China, coming out to our parts of the world. And obviously Indonesia and Thailand will have a part to play. And what I like is also that Indonesia have their own niche in the commodity space, in the EV space. We talk about nickel and all that. But also in the case of Thailand also have their own niche, right, in the automobile space, in the tech space. So I do think that this is one of the rare instances that I can remember, over the last 2 decades of investing in ASEAN, that I can see real FDI coming through for a variety of reasons. Yeah. So I'm very, very positive. In short, I'm very, very positive on Indonesia. And arguably, if you look at Indonesia, I think Indonesia has done very, very well. Right, the US has been strengthening crazily over the course of 2022. In previous historical situation, Indonesia, not just Indonesia, ASEAN in general, will have suffered. But if you look at last year, I think it's still okay. Still well managed. The rupiah is okay. There's no panic selling. Everything was still fine. FDI was still coming in. So I do think that I think ASEAN in general have reached a point whereby the strengths of ASEAN or the hard work that have been put in the last few decades are coming to fruition. And it just so happened that geopolitical crosswinds have led us to this stage whereby we are all in a good position to take advantage of this. Yeah.
Okay. Thank you for the explanations, Jee Toon. I think that's all for now from my side. Pass it back to Alan.
Yeah, thank you, Wafi. Over to you, Tarapat in Thailand. Anything from your side?
Yes, thank you, Jee Toon, for the presentation. I've got two questions from Thailand. So, what are the sectors and the industry that are expected to experience like significant growth in the near future? And the second one is, if we want to invest in the China market, what are the challenges and the risks we should consider?
Okay. I let's answer the first question first. And I think that the sectors of the companies that will experience the highest growth are also the ones that actually experience the most suffering over the course of the last 3 years. So that from my point of view, right, is probably where we can concentrate our attention, and that will include things in the Chinese internet sector. So we have heard of what happened to Alibaba, Jack Ma, and all of that, the internet scrutiny, which I talked about in my previous presentation. Those guys suffered for the last 2+ years or so. It's only late last year, then we start to see this regulatory tightening starting to loosen up. And now it has become regulatory support, right? So I think the Chinese internet sector is something that I think will have a nice rebound over the course of the last few years, just because of the fact that they were whacked down so much and there was so much pressure on that sector over the course of the last 2-3 years. So I think like a hot spring, right? Once you release the pressure, it will tend to bounce back. So that's one sector. Okay. Then the other sector that I like to look at is also on the consumption, on the consumer sector. Same rationale. Last 3 years, we all know the Chinese people are stuck, right? They have it's zero COVID policy, lockdown, Shanghai, China, so many different versions and different ways of lockdown, right? And all throughout that time, they have been saving. They've been saving, their savings are high, they have not been spending, right? So right now, this is the year whereby they will come out and they will spend. So our view is they will spend, but they will not spend indiscriminately, right? So just to share with you, for example, right? They might want to buy, let's say, for example, a lady, for example, in China, they might want to buy a bag that they have always wanted for the last 3 years. Last 3 years, they were fighting for their lives, they don't know whether they'll live. So right now, if they want to buy a Chanel bag or a Louis Vuitton bag or Prada bag that they have always wanted, they'll go out and they'll just buy it. But after buying the Louis Vuitton bag, then they'll go out and eat. But will they eat nice restaurants? The answer is probably not. Because the economy in China is not doing well. They will still eat out, but they will, instead of nice restaurants, maybe they'll eat at AFC or they'll eat at a cafe, a cheaper cafe. So there is a difference in how they spend. It's not like everything is good, right? Everything is good. There's no problems out there. Everybody in China is well aware of the US-China tension, right? So they understand that this and Chinese government has made it very clear that we're in it for the hard times, right? Because there is a pressure externally that's trying to contain China. So the Chinese people are well aware of that. But will they spend? That's it, they will. Will they come out to our parts of the world and spend? They will. But they will not spend as though there's no tomorrow. They will spend on what they want to spend on. But other than that, they will do it in a more conservative sense. So we are seeing that kind of differences happening now as we speak. So these are the two sectors which I can highlight: internet sector and the consumption sector. And the risk is quite easy. For me, the biggest risk is geopolitical risk. So it's something very difficult, something that all of us, it's very hard for us to mitigate against that, right? I can only say that the US-China tension is here to stay. And that has always been my view. So the only way that I can mitigate that is to buy stocks that will benefit because of that. Because it's here to stay. The Chinese will not roll over and play it. They will create their local champions. They will put in massive R&D to try to win themselves off US and European technology. And what the Americans and the Europeans continue to pressure them, that is yes. This is the life that we collectively will all face for the next few decades. Because China is moving up. US don't want China to move up, so they press them down. But China will always try to resist that. So this is the world that we are living in. So for me, it's a fact of life. So I will buy stocks that will benefit in that scenario. So I'm not saying that, I will buy stocks that will benefit because the US-China tension goes away. That is unrealistic. That will not happen, right? So we will buy stocks that will thrive because of this tension. I'll buy the local Chinese champions. I'll buy Chinese companies to benefit from the R&D, benefit from the stimulus, benefit from all the money that the Chinese government is throwing into that sector. Okay, so geopolitics, once again, is the biggest risk that I can see. Yeah.
Okay, thank you, Jee Toon. No more questions from Thailand. Let's pass to you, Alan.
Okay, thank you, Tanapan. Okay, let's continue with some question here from our end. Okay, Jee Toon, the Western countries and Japan has been curbing the semiconductors equipment export, to China. And how do China maintain their technological advancement? And do you think counters like SMIC or semicon related stocks will bottom out this year?
Okay, so just to apologize, I cannot comment on stocks with specific names, but I can comment on the sector. I think this question is obviously very, very relevant. For those of you who are on top of the situation, you will know that over the weekend, just over the weekend only, right? US I would say US and Netherlands, or in particular Netherlands, will probably be very strong guidance from US, have come up with a set of policy in order to contain China, right? So it is a new set of policy that restrict the export of DUV equipment to China. But if you look at the stock market today in China, you'll notice that there's no reaction. Okay, I can explain why. The reason is you can only spin the bad tales or the bad story so many times, right? You can only beat the dying horse so many times, right? So at this point in time in China, people are well aware, they understand totally that the pressure will carry on, right? So if you look at, I think that is, for me, that's very interesting, because it's a new set of bad news, and that is not just from the US, but that's from Netherlands. And yet, if you look at the share price, today's share price hasn't seen too much of a reaction. So I think that if you look at it from that perspective, right, the market has more or less absorbed a lot of this bad news already, right? So just to answer that question in terms of sectors and who will benefit because of that, right? We have to be very, very careful. You can talk about foundries, you can talk about the equipment makers, and even the equipment makers, you can break it down into different categories. And last but not least, I'm just doing some very rough categorization. Last but not least are the, I would say, normal consumer electronic manufacturers, right? So the foundries will always be under pressure, right? Because that is the only way Chinese can advance. So the pressure from the Americans, from the Europeans will carry on. Right? But on the other hand, the Chinese will continue to pump in money, subsidize, promote, right? And in order to make sure that these companies will continue to fly the flag. Because there is no way they will stop and say, forget about it. I'm just contented. I'm just going to give up on this. That's not going to be a solution. The answer is, how long does it take? Is China behind US? For sure. And what is the number of years? Probably 5 years. Anyway, between 3 to 5 years, depending on the technology that we are talking about. Would it take 5 years for Chinese to catch up? I don't think so, right? Because the Chinese will put in the effort, resources to make sure that they can close down that gap, right? And also, more importantly, I just want to highlight that when we are talking about this kind of gap, right, we are talking about commercialization, meaning, right? Chinese can never produce, at this juncture, can never produce something that is competitively priced with the same level of specs, because nobody will buy that because it's too expensive. But in the new world that we are living in, if you divide the world in half, the Western world and the Chinese, or the Sino-centric or the China world, and those people in the China-centric world cannot buy the US technology, then the answer is, then they are stuck, right? Because they cannot get the alternative Western technology. They have to go to the Chinese technology, even if it's more expensive, even if the specs is 10, 15, 20% lower. Because if not, nobody's going to sell it to you. So this is the world that we are living in. So we cannot use the lens that we have now and say that, oh, because Chinese are not competitive, they are not competitive. But in the new world that we're living in, it will be divided, right? China will run their own thing, you Americans or the Western world will run their own thing. So they have to find their niche in this new environment. So in this new environment, obviously, R&D will be supported by the government, resources will be supported by the government, and also the Chinese companies will have no choice but to use the Chinese technology, right? Albeit it might be a bit more expensive, but they have no choice, right? So in essence, I just want to highlight that we are in early stages as in terms of how all this thing goes. The last few months we have seen a whole host of restrictions that the country and the market is trying to deal with that. But I do feel that they are trying to strike a balance. They want to slow China down, push China down for sure. So the leading edge in terms of AI, in terms of EV, in terms of 5G, they will try to push China down, right? So this is the leading edge. But the rest of it, right, they will probably leave China to do what China will do because they want to be the big brother and big brother by a large margin, right? So this is what we are seeing now. Okay, Alan?
Okay, thanks, Jee Toon. Okay, touching a bit on the EV sector, we have seen a strong set of results. Some of these have been, the sales are good in the last few quarters. But China has a problem in producing high-end chips, right? So do you think we should still continue to look into this auto sector?
The high-end chips that we are talking about, right, in essence, only relate mainly to things like AI, right? Things like autonomous driving, things like 5G, and all of that. So the Americans have made it very clear and very targeted in terms of the areas that they want to control China. So it's not a blanket chip ban, right? The chip war is real, but it's also very, very targeted. So they've identified all this as some of the key, right? So in our opinion, right, the EV sector, right, doesn't require that level of chip that is required to train, let's say, for example, the large language model LLMs of the artificial or the AI models, right? So the EV side, I think from our conversations with the Chinese EV vehicles company and also the parts manufacturers, I think they are okay. They are okay from that perspective. They can find workarounds. I don't think that will pull the EV industry in China back by too much. It's only the highest end of the leading edge of the, like I said, the AI sector that is probably going to be impacted quite a fair bit. Okay, Alan?
Okay, thanks. Okay, let's take a question from Facebook that our client Raymond has asked. Since yuan is the worst number 3 currency for the first half of this year, will Malaysia as largest trading partner be impacted?
So again, impacted meaning?
Malaysia as the largest trading partner.
Okay. Sorry, I'm not clear. Are we talking about currency weakness, or is that what we're talking about?
Yeah, he was referring to that the yuan that is one of the worst performer, right? So in terms of Malaysia as the largest trading partner, yeah.
Okay, once again, right, I would push back against that thinking now, because I don't think okay. It's right. RMB is weak on a weakening trend. But I don't think it's any weaker than the basket of currency that it's trading against. So we know that yuan, even though it's quoted against the US dollar, but yuan, the renminbi is managed against a basket of currency, and that basket of currency has ringgit, has Sing dollar, has baht, has Japanese yen, has euros, and all that, a whole basket of currency, and which we monitor as well. So relative to that basket of currency, right, it's more or less in line. It could be a bit weaker for their own reason, but it's not especially weak. So we have to be very careful on how we measure the weakness. What time frame are we looking at, right? Because this year, looking at our calculation, obviously euro is a big part of that basket. Euro has been relatively okay, but last last year, euro was super weak. The pound was super weak, right? Arguably last year, our view was that yuan was trading a bit too strong relative to the basket of currency. So this year, maybe because of what is happening in the outside world, because of the export markets and everything, so they decided to let the yuan come back down. So that is my interpretation. So I would not look at it and say that, oh, it's because yuan is weak and there's a reason behind that. I think they manage it. And if you look at whether there is, whether it's the renminbi in trouble, I don't think so, right? So I would say that the observation is correct, but it depends on the time frame that you are looking at. So if you look at, from my perspective, because we monitor that basket of currency that yuan is, renminbi is trading against, and we are quite comfortable where yuan is, but arguably, I do think that they are purposely making it a bit weaker because of the weak export environment. What they don't want to lose out in this weak export environment. So especially those countries that they are in export competition with, they will try to make it a bit more, maybe a bit easier for these Chinese exporters, right? Okay, Alan?
Okay, thanks. Would you be able to shed some lights into the China or Hong Kong fund flows? What is the appetite of foreign investors in China and Hong Kong market now?
Okay.
And also, is the China local entities continue to buy the Chinese stocks?
Okay, I can share that quite quickly. So I think in terms of, I will break up into different sets of investors. So if you are investors that is based in Europe and US, you have very, very light positioning in China. You probably wouldn't have participated at all too much in the, right now, politically, we have seen universities, endowments in the US talking about having ex-China portfolio. So the political environment in China is obviously, if you're Americans, you can easily imagine what it can be. So that's why the Americans have not participated much at all in China, right? And they are a significant part of the financial markets. So if you look at the Europeans, I would say about 50-50. 50% of them are in, 50% of them are still out. The only guys who have participated more actively is people or investors in our parts of the world, meaning Asia, North Asia, because we are more familiar with China. So we are the ones that actually participated in the 60% rally that we saw, because we were quicker, we understand what's going on, right? So just to make that this distinction. So if you look at it in terms of positioning, it's still very light. China is a consensus underweight for most global portfolio. So that's also another reason why I'm quite positive, because a stock can only go down when, there are things to sell. If you sell finish already, the stock won't go down much already, right? Because there's nothing more you can sell. So I think we are probably in that situation for a lot of these global portfolios that are managed by the Americans or the Europeans, right? So the Asian guys, probably my bet is they're probably neutral China at this point in time, right? On average, okay? So in terms of the domestic guys, I would say are still quite conservative. Are they positive on China? I don't think they are massively positive, but they are positive on certain segments. EV, AI, renewable, right? The SOE teams, those are the teams that they can see and they can touch, right? And they are positive from that perspective. But do I see animal spirits in China at this point in time? The answer is no, right? Not at this point in time, which also, from my perspective, makes it so attractive, right? Because right now, I do think that the pessimism has been pressing too much in the Chinese stock market at this point in time. And we are seeing signs of reversal on a variety of fronts in terms of regulatory, in terms of the reopening, in terms of consumption picking up, right? So, in terms of also more importantly, the Chinese internet sector, if the regulatory tightening ends and become loosening, then we can see uptick. But that will probably be in the second half. So for us, I'd rather be positioned for the uptick in the second half of this year. Yeah. Alan?
Okay, thanks. You did mention that the China domestic consumption is not as high as we were expecting. Yeah, it has been moderated a little bit.
Yeah.
So the question is, what's your your view on the upside on sports apparel related stocks.
Okay. My view is that I think sports apparel stocks have done well previously because of the Guochao or the patriotism wave that have happened, right? So this time around, we are, and also because I think to a certain extent, because at that point in time, there's nothing much you can spend on. Maybe sports was one of the things that it probably makes sense for you to spend on sportswear. Probably pick up a new sports during the whole COVID lockdown period. Which all of us did. When you get a new bike or pick up a new sport, more yoga, Pilates or whatnot during the whole period. So we are seeing that happening. But having said that, right, what we're seeing in the post-COVID world is that that expense or the consumption spending has broadened out. Right, so it's you can only spend a few things, right? Because you're stuck at home. What can you do? You can only shop online. You cannot go movies. You cannot do. So there are very few things you can spend on. So those things that you can spend on tend to do quite well. But now that it's opened up, right, then suddenly your menu of choices goes open up massively, right? So that is what we are seeing now. So for me, I do have an exposure to the Chinese sportswear previously, but now I do feel that the menu has opened up. There are a lot more things that I can play now, all the way from consumption overseas to consumption to tourism to experiential type of consumption, meaning like a movie, right? Like a tour, right? Something that you experience rather than something material, right? Like a watch or a pair of running shoes, right? So that the consumption pattern has changed. So our portfolio has also shifted as a result of that.
Okay, thank you, Jee Toon. Okay, maybe we take the last question because due to time constraint. Okay, some say that China commodities demand is low now. So the domestic demand is too low that the steel manufacturers are looking at exporting the steel again. So what you think about China commodity market and how we should position ourselves?
Okay, so for the Chinese commodity market, like what I mentioned earlier, the commodity stimulus or the infrastructure stimulus will be very, very targeted. The steel consumption, steel that are used for property will obviously be in a weak position because property sales have been weak. Like what I mentioned earlier, right? Only if you are very, very strong, on your balance sheet, you are well connected to the central government, then as a developer, it's only then would potential buyers buy your property. But in general, if you are not, then then they will suffer. So in general, property sales in China will tend to be quite weak as well. So that will have an impact on steel prices. That's for one. And the other thing is also in terms of infrastructure. It's very, very narrow. It's not the roads, it's not the railroads that we have seen of previous years. It's in terms of telecom infrastructure, in terms of grid, smart grids. It's in terms of renewable energy, right? Those type of infrastructure. So it's not as simple or as basic as steel nowadays, right? So our view is that we need to make that differentiation between, let's say, China opens up, and therefore, simply saying that commodity prices will go up as well. We need to make that differentiation between which set or which subsector of commodities would do well because of this recovery and reopening. Alan? Okay,
thank you, Jee Toon. Unfortunately, this is the last question we can squeeze in. As much as I still got a couple of questions that I have, but that's the only time that we have for today. Maybe we should have a round two with you, Jee Toon. Well, but anyway, thank you for addressing all the questions that we managed to do. So before we conclude today's webinar, I would like to thank Mr. Tan Jee Toon from RHB Asset Management Singapore for your sharing and very interesting insight into the China market. And also a big thank you to all the participants for joining us from near and far in our regional countries. We will continue to see you live through RHB Morning Kappa at 8, Facebook group at 8 a.m. every day. Get up to date with RHB research team before the market opens every morning on latest trending trading ideas and direction of the markets and sectors. So till the next session, have a good week ahead, and I shall see you again soon. Thank you.
Thank you, Alan. Thank you, everybody. Thanks for your time. Thank you. Take care.